What if I told you there's a little-known Singapore construction company that's quietly sitting on more than 80 million Singapore dollars in cash, generating steady free cash flow, and trading at less than 1x book value? While the big players like Capitaland and Keppel dominate headlines, this under-the-radar firm has been quietly turning around from years of losses into double-digit return on equity. Today, we're going to dive into Lum Chang Holdings, a company that may not be flashy, but its numbers tell a story of resilience, cash strength, and potential undervaluation. Could this be one of the most overlooked small-cap plays on the SGX? Let's break it down. Lum Chang Holdings isn't just another construction company. It operates across three core business segments: construction, property and investment, and interior works. The construction division is the backbone of the group, delivering some of Singapore's most iconic projects, from large-scale infrastructure like the North-South Corridor and Family Justice Courts, to conservation works at heritage landmarks such as the National Museum and Red Cross House. This segment continues to win new tenders, ensuring a steady pipeline of projects. The property and investment segment focuses on real estate development and investments. In Singapore, Lum Chang has developed award-winning residential and commercial projects, while in Malaysia, the group owns and develops the Twin Palm Sungai Long Township near Kuala Lumpur, featuring luxury bungalows and semi-detached homes. The group has also selectively invested overseas, including past ventures in the United Kingdom and China. Meanwhile, the interior division adds value by handling high-quality fit-out and finishing works for corporate offices, retail, and hospitality developments. This business complements Lum Chang's construction arm, offering an end-to-end solution from building to interiors. Geographically, Lum Chang's core markets remain Singapore and Malaysia, supported by its regional subsidiaries and joint ventures in Indonesia and previously in the UK. With over 8 decades of history, the group has built a strong reputation not only as a builder, but also as a trusted property developer across Asia. In short, Lum Chang is more than just construction. It is a diversified group, spanning infrastructure, real estate, and interiors, with a footprint anchored in Singapore and Malaysia, and an eye on opportunities across the region. Now, let's take a closer look at how Lum Chang's revenue is spread across its business segments and regions. The exact figures aren't published, so what you're about to see are illustrative charts based on the qualitative emphasis in the company's annual reports. In other words, these are not official numbers, but rather an estimation to help us visualize the company's business mix. From a segment perspective, the construction division is by far the biggest contributor, accounting for an estimated 70% of revenue. The property and investment arm makes up around 20%, while the interior business contributes about 10%. When we switch to the regional view, Singapore dominates the revenue share at around 80%, followed by Malaysia at about 15%, with the remaining 5% coming from other markets, such as the UK and China, mainly from past investments. This breakdown highlights how Lum Chang's strength is anchored in Singapore's construction sector, with supplementary contributions from property development in Malaysia and smaller exposure to overseas projects. Now, let's take a look at Lum Chang's financial performance over the past 4 years, from 2021 to 2024. Starting with revenue, the group has maintained a stable top line, around 400 Singapore dollars to 500 million Singapore dollars each year, showing consistency in securing construction and property projects. When it comes to profitability, 2022 and 2023 were tough years with losses, mainly from project delays and rising costs. But in 2024, Lum Chang turned things around with a net profit of about 9 million Singapore dollars, reflecting better cost control and stronger margins. Looking at the balance sheet, total assets remained steady at around 440 million Singapore dollars, while borrowings were reduced from over 227 million Singapore dollars in 2021 to just 68 million Singapore dollars by 2024. This shows a significant deleveraging and stronger financial footing. Shareholder equity has gradually declined from 258 million Singapore dollars in 2021 to 166 million Singapore dollars in 2024, largely due to losses in prior years. Still, the company continues to reward shareholders with dividends, 1.5 cents per share in 2024, after paying as high as 6 cents in 2021. Finally, earnings per share also reflect a turnaround story, from a small profit in 2021 to losses in 2022 and 2023, and back to positive territory in 2024. In summary, Lum Chang shows signs of recovery, lower debt, a return profit, and still paying dividends. But here's the red flag. In 2021, EPS was just 0.79 cents, yet shareholders received a total dividend of 6 cents plus a 4.25 cent special payout. That's far more than earnings. The company likely dipped into reserves or cash buffers, which raises questions about dividend sustainability if profits don't keep up. Quick break. If you made it this far, smash that like button. The YouTube algorithm loves likes almost as much as I love durian. And don't forget to subscribe. I spent hours sweating over reports and editing. My laptop fan now sounds like a cargo ship. So hit like, subscribe, and keep this channel sailing. Starting with market cap, the company grew steadily from about $175 million in 2021 to nearly $270 million by 2024, reflecting investor confidence despite uneven earnings. Enterprise value shows a similar climb, from $160 million to around $224 million. The price-to-book ratio moved up from roughly 1.3 times in 2021 to 2.7 times by 2024, meaning the stock now trades at more than twice its net asset value. Looking at profitability ratios, return on assets stayed modest between 1% and 8%, while return on equity fell from double digits in 2021 to 2022 to just 7.4% in 2024. This indicates shareholders are getting less return per dollar of equity compared to earlier years. EV over EBITDA dropped sharply from about 9 times in 2021 to just 4.5 times by 2024. That suggests the stock has become cheaper relative to its cash earnings. Similarly, EV to sales declined slightly, showing improved value for revenue generated. And finally, net asset value per share rose from 13.6 cents in 2021 to 16 cents in 2024. Evidence that the underlying book value has inched higher even as profits fluctuated. Overall, this table tells a story of a company with steady market valuation growth, cheaper earnings multiples, but declining returns on equity. It's a mixed picture, attractive on value multiples, but weaker on profitability. Now let's put Lum Chang side by side with two other SGX-listed construction companies, Cole Brothers Eco Engineering and Soil Build Construction Group. Looking first at revenue, Lum Chang remains the largest among the three with about 500 million Singapore dollars, while Soil Build comes in at around 392 million Singapore dollars, and Cole Brothers trails with about 149 million Singapore dollars. In terms of profitability, Lum Chang managed a return to profit in 2024 with about 9 million Singapore dollar net income. Soil Build showed a much stronger rebound with net income above 28 million Singapore dollars, while Cole Brothers report a loss of about 17 million Singapore dollars. On the balance sheet, Lum Chang holds the strongest cash position at 82 million Singapore dollars, while both Cole Brothers and Soil Build have around 58 million Singapore dollars each. Debt to equity is relatively low for Lum Chang at 23%, but higher for Cole Brothers at 37%. Valuation-wise, Lum Chang trades close to book value with a PB ratio of 0.96 times, while Cole Brothers is richer at over 2 times book, and Soil Build's ratio fluctuates as it recovers profitability. When it comes to dividends, Lum Chang continues paying, though not without controversy. Soil Build has resumed distributions recently, and Cole Brothers suspended dividends after its loss. Overall, the comparison shows Lum Chang as a steady mid-tier player with strong cash reserves, Soil Build as the more profitable in the latest year, and Cole Brothers struggling with losses. For Lum Chang, the opportunities are clear: a steady construction pipeline, recurring property development projects, and multiple revenue streams across construction, property, and interiors. The company also enjoys a strong balance sheet with low debt and solid cash, plus potential growth from green building trends and regional expansion. But the risks are equally important. Construction margins remain thin, and both property and construction are highly cyclical. Equity has been declining, while dividends have sometimes exceeded earnings, raising sustainability questions. Add in project delays, regulatory pressure, and strong competition, and you see why investors need to balance the upside with caution. So what's the final verdict on Lum Chang? This is a company with over 8 decades of history, a proven track record in Singapore's construction sector, and a balance sheet that shows resilience with low debt and healthy cash reserves. The turnaround back into profitability is encouraging, and its property and interior segments add depth to the business model. But investors should remain cautious. Margins are razor-thin, equity has been eroding, and past dividend payouts that exceeded earnings raise concerns about long-term sustainability. In short, Lum Chang may be attractive for value-focused investors seeking exposure to Singapore's construction and property cycle, but it comes with risks that cannot be ignored. If you found this breakdown useful, hit the like button, subscribe to the channel, and drop a comment below. Do you think Lum Chang is an undervalued gem or a risky small cap play? I'd love to hear your views.